To anyone looking at the American economy in the early 2000s, the housing market appeared completely indestructible. Homeownership was rising, property values were climbing, and millions of people were treating their houses like ATM machines. But beneath those manicured lawns, the foundation of the market was actively fracturing. The highest authorities in finance completely ignored the math. In 2003, Federal Reserve Chairman Alan Greenspan publicly dismissed the idea of a real estate bubble, assuring lawmakers and the public that a nationwide housing crash simply did not happen. Dr. Michael Burry, a neurologist turned hedge fund manager, decided to audit the system himself. He logged into his computer and started downloading hundreds of pages of raw SEC filings, reading through the actual data inside individual mortgage pools. Burry decoded the collapse by analyzing the dense mathematical blueprints of the mortgage market, data that the rest of the financial world was content to ignore. To understand what Burry saw, we have to look at how home loans used to work. Traditionally, if you wanted to buy a house, a local commercial bank gave you the money. That bank held on to your mortgage for 30 years. They held the risk. If you stopped paying, the bank lost their money. By the 2000s, that model had completely shifted. Commercial banks stopped holding on to these loans. Instead, they wrote the mortgages and immediately sold them off in massive quantities to Wall Street investment banks. The commercial bank got a quick payout, successfully handing the liability off to someone else. Wall Street bundled thousands of individual home loans into a single giant investment product, a mortgage-backed security. To sell these to investors, banks divided them into slices, or tranches, based on risk, equity, mezzanine, and senior. If homeowners failed to pay, the bottom equity tranche absorbed the hit first, shielding the layers above. Because equity absorbed the initial risk, it offered the highest payouts. The senior tranche was safe, but offered lower returns. Institutional investors around the world were desperate for those high yields, pouring billions into these products. Lenders prioritized the sheer volume of loans over borrower quality, turning the banking process into a high-speed assembly line for Wall Street's raw materials. To feed Wall Street's appetite, commercial banks started scraping the bottom of the credit pool. They aggressively marketed loans to borrowers with poor credit histories and no verified income, approving mortgages that never would have passed a traditional background check. The Federal Reserve accelerated this borrowing frenzy. Between 2001 and 2003, they slashed interest rates down to a historic low of 1%. Borrowing money suddenly felt practically free, sending housing prices soaring as buyers rushed the market. This chart shows the primary trap lenders use to pull in those high-risk borrowers, the adjustable rate mortgage. The loan starts with an artificially low teaser rate, keeping monthly payments highly affordable. But after a few years, that teaser period expires, and the interest instantly spikes to a much higher, unmanageable payment. By 2003, lenders mutated this product into the negative amortizing loan. Borrowers with zero income were given the option to pay absolutely nothing each month. The interest they missed was simply tacked on to the total amount they owed, meaning their massive principal debt actively grew larger every single month. This entire ecosystem of toxic debt relied entirely on one mathematical assumption, that housing prices would rise endlessly.
As long as a house kept gaining value, a broke homeowner could take their newly acquired equity, refinance the loan, and lock in a new teaser rate before the trap snapped shut. Michael Burry saw these zero-payment, interest-only loans hitting the market, and he went straight to the official SEC filings. He meticulously read the dense, highly technical prospectuses for these specific mortgage pools. The data showed a system rapidly degrading. Credit standards inside the pools were collapsing as lenders issued loans that required constant double-digit home price appreciation just to keep the borrowers from defaulting. Look at this timeline of loan maturity dates. Burry calculated exactly when the teaser rates on the vast majority of these toxic adjustable mortgages were scheduled to expire. The data points formed a massive concentrated cluster right at the year 2007. The housing market was built on a series of hard-coded reset dates that would inevitably collide, forcing millions of homeowners into default once their teaser rates vanished. Armed with the exact expiration date of the mortgage market, Burry decided to bet against it. He specifically targeted the lowest, riskiest equity tranches of those securitized mortgage pools, the exact layers designed to absorb the first wave of borrower defaults. To make this trade, he used a specialized contract called a credit default swap. Burry's fund, Scion Capital, agreed to pay a steady stream of monthly premiums to a major bank. In exchange, if the underlying mortgage bonds failed, the bank had to open the vault and pay Burry the full value of the bonds. It is the exact financial equivalent of buying a fire insurance policy on a house that you do not personally own, and then waiting for it to burn down so you can collect the payout.
Burry approached global institutions like Deutsche Bank to purchase these swaps. Wall Street firms thought the housing market was perfectly stable, so they were thrilled to take the other side of the trade, gladly collecting Burry's premium payments. Burry committed massive amounts of his clients' capital to this position. He placed his entire fund in direct opposition to the foundational asset of the American economy, risking his career on a purely mathematical conviction. As the timeline hit 2007, the math caught up with reality. Teaser rates expired, broke borrowers were unable to refinance, and defaults skyrocketed. Housing prices plummeted, leaving millions of homes in foreclosure. The destruction of the equity tranches triggered a brutal chain reaction. The defaults were so massive that they quickly wiped out even the heavily protected senior mortgage products, sending severe panic through the institutional banks that assumed they were immune. As the real estate system imploded, the value of Burry's insurance contracts exploded. The same Wall Street firms that eagerly sold him the swaps were now desperately trying to buy them back to protect themselves from total ruin. When the dust finally settled, Scion Capital posted net returns of nearly 490%. Burry secured a personal profit of roughly $100 million and cleared over $700 million for his investors. The 2008 financial crisis was an inevitable mathematical outcome of an industry prioritizing greed and loan volume over basic credit standards. Michael Burry made one of the most profitable trades in history simply because he was the only one willing to read the warning labels.